Okay. So here we are. We're going to go ahead and get started, and I'm hoping that other people will join us as we go along. But I like to get started on time. So tonight is going to be a lot of fun because in the secret number 2, creating capital, we really get into some of the more creative and fun topics of the shadow banker secrets, because Ben talks about banks creating money out of thin air, and essentially we're doing something similar through the shadow banking process. I'm always fascinated with what BlackRock is doing, although they're the villains. I'm still fascinated by what they do. So this is some fun stuff, and we're going to be focusing tonight on pages 114 through 127 in the book, or the master class. It's around an hour and 55 minutes to about an hour and 5 minutes would be my guess, maybe a little bit less than that, but somewhere around there, or 2 hours and 5 minutes, 155 to 205 if you're following along on that, which is about where I am here with my screen share. And so we're going to jump into it tonight by talking about hedge funds for a few minutes. Does everybody see that hedge fund schematic there on the screen? Can you see that hedge fund schematic okay?
Yeah.
So I wanted to pull this up and kind of have this in mind as we're talking about hedge funds. And I want to compare some of the discussion that Ben has about hedge funds to what other people like Bridger Pennington has about hedge funds, because Ben mentions that there are those that basically have an overly simplistic definition of hedge funds, and our wonderful brother Bridger came to mind. Because he defines a hedge fund as basically nothing more than, shall we say, the efficient type instruments, stocks, bonds, options, things that come out of the markets, out of Wall Street, basically. And in a word, he's right, but he's very limited in his definition. And so I'm going to get to that in just a second. But before we get going, is there anybody, either of you guys have any questions or comments about where we're heading at this point?
I don't think so.
Okay.
I don't have any.
Okay. So just jumping back into it then, Ben starts out by defining hedge funds in their original intent, where they were designed to hedge risk. And it's interesting because as we look at Adagio and we look at our structured products, and we're going to find out later on in this section that a structured product, as we've been referring to them, is a little more than just simply a fund. He puts it all within the shell of a fund, but it's still a structured, a structured product. And we'll talk about that in a minute. But going back to hedge funds, you can see there on the screen that there's kind of a structure. You've got the fund that's buying or acquiring the alternative assets. If you're trying to do this to truly hedge risk. Now, you could invest strictly in a strategy of bonds and certain types of paper, market paper, and that kind of thing. Bonds, stocks, options, things like that. More along the lines of Bridger's definition. But essentially, you've got the fund. I would still look at this from the context of what it says hedge fund there. It's still broken up between a GP and an LP, or a limited partnership that has a GP with limited partners. And your limited partners are all those investors coming down off the left. I think what he goes into here, if I understand this diagram correctly, is he goes into a little bit more detail here with respect to the role that different players have within this fund structure. And Jody and I have talked a lot about this, where you have, they don't have it pictured here, but third party due diligence. You've got third-party verifiers of your accredited investors. You've got third-party administrators. You've got auditors. You've got your legal advisor. Ben has added the registrar and the transfer agent there as well. And one of the reasons why we're looking at all this from a third-party standpoint is later on in this section, he's going to talk about operational rigor. Now, this is interesting because the first chapter, the first section, the first secret is all about financial rigor in terms of the risk-adjusted performance measures, the alpha, the beta, the Sharpe ratio, you know, the sigma, you know, the four statistical measurements of a singular event, which has skewness and kurtosis, and there's a couple others I can't remember off the top of my head. I really am trying to remember all this and remember what they mean. But that's the financial rigor. You know, it's all about the risk. And of course, it comes over into the allocation of assets based on risk. That would be part of the operational rigor, I would suppose, but it involves financial rigor. And then last week or so, and you know, with his third and fourth podcasts and the sections we were going through, we've talked about marketing rigor. And so I think he likes that word, rigor, and I'm starting to like it myself. But in the marketing rigor, we're going into the aspects of knowing who your avatar is. We've read Flip the Script, you know, by
Know your who.
I'm sorry, what?
Know your who.
Yep, know your who, all of that. So there's your marketing rigor. Well, in this particular section, he brings up operational rigor. And operational rigor is something that we can take advantage of to manage risk better, manage perceived risk better, and that's by, and of course, that has a market appeal, because instead of the investor having to look so hard at each of us as fund managers, asset managers, or portfolio managers, they can begin to focus their due diligence on who's your auditor, you know, who's your third-party administrator, who are your brokers, who's your legal advisor, and on and on and on. Because you're basically outsourcing all of this. You're not trying to hire the talent internally. You're not big enough yet to hire it internally anyway, right? But if we essentially contract with these third parties, they have their track records, they have their success, and it now allows, you know, an investor to get more comfort that you really know what you're doing. And so I just wanted to point that out. I think we'll probably get into that a little bit later. I'll mention it again as we fly by, I guess. But going back to the hedge fund here for a second. Hey, CJ, welcome. Feel free to jump in if you have any thoughts or comments.
Absolutely, thank you.
Or questions. We're just talking about hedge funds as it relates to hedge funds on page 114 to 115. But this goes into some of the setup of all of our funds, depending on what kind of fund you want to do. And so he talks about the 2 and 20 structure, the 2 and 20 free structure. I don't know if anybody has any questions about that. If they do, we'll stop and talk about it. Otherwise, I'll just kind of gloss past that, because I think everybody knows what a 220 is for. I would mention this, and this kind of something that Bridger points out, and Ben also pointed it out in a meeting that we had not too long ago, and that is that in order to collect the 2% off the top, you've got to have a 65. You've got to have a FINRA 65. But you can structure that in a waterfall so that you still get your 2 and 10, or your 2 and 20, without having to be a FINRA 65, and that starts with being a general partner in that limited partnership. Being a general partner does not require you to be FINRA licensed. And it may require you to take that 2% a little bit differently, but we can talk about that later when we want to get into details. But anyway, just wanted to point that out, that he talks about the 2 and 10. And then
Hey, Mark.
Yeah.
Real quick on that. because Ben mentioned the RIA in a box,
Yes.
and that our fund could be, what was that? Where the fund could be set up, and if you have less than 150 million assets under management, you didn't have to be registered, or
There's
what was that?
Yeah, that's part of it. That's part of it. There are some loopholes. Again, I'm using the term loophole very cautiously. You know, when we're talking about taxes, we throw loopholes around like, you know, they're candy. But, you know, you can take advantage of a loophole that the IRS doesn't agree with, and you won't go to jail for it. You just pay the tax, right? With the SEC, if there's a loophole that you don't go through it properly, that can land you in jail. And so I want to use the term loopholes very carefully, but there are exceptions
Maybe
and
exception.
exceptions
I
and
was-
exemptions. And that
That's
if
what I was
certain rules are properly followed, you're entitled to that certain section or excuse me, exception or exemption, and therefore you're entitled to the metaphorical proverbial loophole, as it were. So they are there. Just be very cautious and careful. This is where Ben's talents with respect to compliance come in. Very, very, very important. He was known probably as a compliance guru before he ever became famous at anything else. And so if you have any doubt, just talk to Ben or message Ben about something, you know, because he does know these exceptions and exemptions. He does know these loopholes very, very well. He will actively use them or recommend them, but just make sure that you're dotting your I's and crossing your T's, because the last thing you want to do is get yourself caught on something like that. Anyway, I'm going to kind of move on there, but good point, Jody. Thank you. Talking about fees a little bit more. He mentions the concept here on page 115. He says many financial advisors and due diligence firms focus on the fee structure of the management. Now, I can understand why, you know, because fees can be all over the map. They can be 220, which is the standard industry, that's the industry norm, but they go down and they go up. And so people are going to look at your fee structure. But here's the point that he makes, and this is really cool. He said, when looking at due diligence on a particular fund, or in the case of our case, where we're setting up a fund and we're trying to decide what do we want to charge for our services, right? He says the person doing the due diligence needs to focus on performance net of fees. Why do you suppose that is? Regardless of what the fee structure is, you got to look at performance net of fees. This is our dose of common sense. Why do we got to look at it net of fees?
If the fund's doing good, it's doing good regardless of the fees, right?
Bingo. And if it's doing bad, it's doing bad regardless of the fees. So you can have a high fee fund that net performs extremely well. Well, why look down your nose at the fees when you're getting a great return, and it's secure and it's properly managed and all those kinds of things? Where you got somebody else going, oh yeah, we don't charge that much for our fees, and yet you're gonna lose your money.
Right.
So exactly. So that's the key. And so the marketing aspect of this, because I'm going to talk a little bit about some of the things that we've talked about, Jody, with Ben tonight, in light of all this, just to kind of help light some fires. But, you know, if somebody comes back on you and says, hey, your fee structure is too high, your waterfall is not generous enough, whatever, right? The key is, how is it performing net of those fees? Are you getting the good return? Are you getting a return that meets your goals? It kind of reminds me of a story. I like telling stories, so I'll share an unrelated story with you. But I spent a number of years working for that Mickey Mouse company that Ben refers to as a Mickey Mouse company, Disney. And I love Disney history. And so the lesson here on fees is driven home based on a story that came out of the opening of Disneyland in 1955. It was called Black Sunday because Disneyland opened on Sunday. And it was called Black Sunday because they just laid, I mean, first of all, the heat was just unbearable. I think the heat was well over 100 degrees. So imagine being in Anaheim on a July day in 100-degree heat going into the park, and it is just absolutely wall-to-wall people. If you've ever been at Disneyland or Disney World under those conditions, I'm sorry. But you can probably imagine what it was like. But in this case, it was even worse because coming up to opening day, there was a plumber's strike. And the plumbers had not finished the bathrooms or finished the water fountains in the park. And so Walt went to the plumbers and union and basically said, please, he got down on his hands and knees, hat in hand, and begged, I've got to open the park on this day. Can you please help me out? And I'll come back to that in a second. It was so hot that the newly laid asphalt, women's high heels were breaking off in the tar. I mean, again and again, you can just imagine how chaotic everything was. With all the planning, with all the training, with all of the effort to make it a wonderful experience, it just seemed like everything went wrong. Going back to the plumbers for a second, the plumbers union came back and said, well, we can give you either the bathroom or the water fountains, but we can't give you both. Because again, they had to honor the strike, right? So Walt said, well, people are going to need restrooms more than they're going to need water fountains. So give us the restrooms and we'll do without the water fountains on opening day. And they complied. And so they did have working restrooms. That was about all that worked. Anyway, it was real interesting because they had Disney employees running around with buckets of water and ladles and cups, and they were ladling water into cups for the guests as fast as they could because the guests, again, didn't have drinking fountains. Anyway, on their way out the gate that night when the park was closing, Walt was walking out with the people, listening to them, listening to their comments. And one lady saw him and came up to him, and she was really in kind of a froth. She said, for this kind of experience, this was way too expensive. And Walt just kind of smiled and hung his head a little bit. He'd been through everything that I just described. He said, well, ma'am, did you have a good time? And she said, we had the time of our life. And then he looked her in the eye and said, then it was worth it, wasn't it? And she said, yeah, it was. Anyway, the lesson being is it doesn't matter what you charge. If you give them good quality service, good quality results, you're gonna, it doesn't matter. They're gonna pay for quality. They're gonna be happy to pay for that return that they're getting. Anyway, just thought I'd add that little story there. Any other comments or ideas as we go?
I just have to, I remember when Ben was talking about how if you take care of your downside, the upside will take care of itself. And that's just a bit of common sense that I definitely want that to stick with me. So
Absolutely. Yeah, perfect. That saved me a long story. Thanks, CJ.
I mean, I never thought about it like that, because he started out saying that you cannot predict, anything. You can't predict what the stock market's going to do. You can't predict all of these outcomes. Just take care of your downside. And boy, does that just cross out all these other quote unquote priorities, right?
Mm-hmm.
Just make sure that risk is mitigated.
Yep.
So.
Absolutely. Thank you. Just a comment about risk-adjusted performance measures. He talks about how a lot of hedge funds today will back test or show their track record as a way of showing really good results. He said, be careful, because too many of them don't go back to a full market cycle. They only catch the last few years where things have been pretty good. Obviously, the market's turning down now, but you've got to include a complete market cycle. And so when you're looking at competitive hedge funds, look at how they measure their, how they measure their results, and do they incorporate data for years that include those down years, or going forward, including data that includes these down years. So just remember that you're looking at that market risk factor. A couple of other things about hedge funds. I want to go a little faster here so we can get through the section tonight. But again, Ben identifies 9 different types of hedge funds, and they have to do with the types of strategies or your investment strategy, rather than just taking that very broad brush definition that our brother Bridger does. Brother Bridger talks about the long short funds, basically, stocks, bonds. He can specialize, he might describe specializing them as market neutral funds. These are funds that have a beta of somewhere around 0, I believe it is, if we've done our homework properly. It's the ones that are market neutral, that they're not either positively impacted by the market or negatively impacted by the market. But they're neutral. I think that's a beta of 0. Somebody correct me if I didn't remember that homework assignment very well. And then you got convertible arbitrage funds, and you can go back down through this list and you can read all these different kinds of funds and kind of imagine what it might be. For example, a convertible arbitrage fund might be what? Anybody got an idea? What might you be investing in with a hedge fund with convertible arbitrage funds? Anybody ever hear of option straddles or options, where you're buying options and you're expecting a stock to really go up, and so you buy an option so you can buy more and control more shares and realize the gain of that upward momentum with more shares and options, right? Or the same thing with down. Straddle is one where you're arbitraging it basically, or you're essentially protecting your risk, where you're buying so much up and so much down so that regardless of which way it goes, you make money either way. You lose the limited investment if you're betting on it going down. You lose the limited investment of it going up, and then you make a lot of money on it going down, right? Have you guys ever done any of that? Ever traded options? Okay. That I'm guessing would be something you might put into a convertible arbitrage. Again, I reserve the right to be wrong, but I'm just kind of going based on the descriptive titles of these types of funds, what kinds of instruments, hedge instruments, might be in there. How about an event-driven fund? What do you think an event-driven fund might be? Again, thinking stocks, bonds, options. What would an event-driven fund be?
Are you talking more like an IPO?
Yeah, you could possibly have a strategy of investing in IPOs or stocks. In fact, one of the best investments, Jody, that I have ever made was it was bought and sold on the market like it was a stock, but it was a company that sold its shares like a mutual fund, if you will, of private companies that they were getting ready to take public, or that they knew were getting ready to go public. And so I was invested in companies like Spotify before it went public. I was invested in a whole mutual fund of private companies that were very successful and very large, like Spotify. I think Uber went this way. I believe Facebook went this way. There are some very famous publicly traded companies today that were once private, spent many years as private companies, and then they were bought up by these funds that then when they went public, of course, they sold their interest in the fund and made a huge profit. Of course, that went back and got distributed to all of the investors in that fund. And so one of the investments that I was in, can't remember the name of it off the top of my head, but it probably had investments in about 60 different private companies. And there were a few unicorns that came out of those. And so, you know, when they went public, and of course that made huge returns for us. And so, in fact, I had to get back into that one. I like that one. But, you know, it's an event-driven fund. The IPO is the event, right? And they were investing for that event. I imagine there's can be some event-driven funds that are essentially designed to hedge against, things like rising interest rates. You know, we've seen the Fed raise interest rates now 3 months in a row, and we're looking at a fourth. And so, in fact, they're estimating right now that the Fed may raise the Fed fund rate now by another entire point in the next meeting.
Oh, the cabal.
Yep. So, you know, those are
Yep.
event funds, I would presume. There's macro funds. You know, macro funds might be something like investing in high level EFTs and things like that. I don't know. I'm just guessing. It's just what I'm defining the fund based on the name to be, unless somebody knows better than me. There's distressed securities funds. So those are your undervalued assets. I'll tell you what, if somebody's got a good way of picking undervalued assets and you go in and buy options, oh my goodness, you can make a ton of money. Emerging market funds. So there's a type of fund there that you obviously can go in and say, okay, I'm going to invest in things coming out of Silicon Valley or you know, other high tech, you know, disruptive technologies or other disruptive type companies. Then there's the long and shorts again, but one where you just go totally long versus totally short. Fixed income arbitrage funds. Now, that one right there, based on the description that I'm going to go over to you when I show you Ben's secret sauce, it sounds like an alternative asset fund. And so that, you know, that's probably number 8 where I would put alternative assets if I've got this right. And then there's merger arbitrage funds. So, you know, where you've got some potential mergers taking place. It's kind of like that event-driven fund where you're looking at investing in mergers, acquisitions, perhaps, kind of a type of private equity, but you're doing it through market level funds, market quality funds, stocks, that kind of thing. So anyway, there's some types of hedge funds that we've talked about. And then he goes on to explaining, but what we do, talking about Adagio and what we're doing as disciples of Adagio, if you will, is in the comparing to the world of manufacturing cars, we're manufacturing a Tesla. It's a disruptive technology. And Jody can relate to this because this is why she's spent so many sleepless nights trying to figure out how do we market this, right? Because
What is it?
the car,
What is it?
yeah, the car is defined as something that takes gas, right? And if that's the case, then Tesla isn't a car. That's how you define a car, right? It runs on gas. We don't sell golf carts. So anyway, what Ben is saying there basically is we do have a job to educate RIAs and fund managers and other people that what we have is truly a car. It's just that it runs on a different fuel. And he points out that the reason why he calls his structured products is so that they have a sense that they're buying a thing, that they're buying an asset. But the structured product, as Ben says here on page 117, is really a fund. And so, you know, we talk about a structured product that we're using in tandem with the CoGP program. That structured product is a fund, and we're literally just buying into a fund. But he calls it a structured product so that essentially when they buy that, they feel like they're buying something. You know, what's the deal? You're buying something. Called a structured product. And in this case, he defines it. And I wonder how many of you guys can define Ben's sauce, his secret sauce, when he engineers a product? Did anybody pick up? Anthony, did you pick up on that perhaps? Where Ben says we've created a product engineered to do a certain thing. For example, there's the one type of product where he's engineered it to be super safe, like treasuries and annuities, and yet have an inflation busting return. Okay, keeps ahead of inflation, and that's a structured product. Does anybody know what he did to make that product, to engineer that? He tells us. Okay, I'm gonna point it out to you. Here you go. I discovered this while I was preparing for this discussion, and my eyes just bugged out. Okay, he tells us what it is. On page is it 117? I think it is. Yeah, it's 117. Here it is, 117. Okay. So he says the industry still has an expectation that structured products are a fairly specific thing. Here you go. Now he describes it. This is what it is. Here you go. It's a fixed income instrument created by layering options over an index. So if you ever wanted to know what Ben was doing to create a structured product, he's given away the secret to the kingdom right there.
What page is that on?
117, second paragraph.
But Mark, he's also saying that, but there is a bit more willingness to accept that the structure might not strictly conform to the familiar.
That's correct. That's absolutely correct. That's what he's trying to help us with. In other words, as we've scratched our heads about marketing this and telling people what it is, you can tell them it's a structured product, it's a thing, okay? And that structured product is a fixed income instrument created by layering options over an index. And now, with that statement, is every structured product identical? Probably not. Again, I don't know his secret laboratory, so I don't know what he's really doing, right? But if that's the general approach, that's something then we can share people. And they might say, well, what is the fixed income item? What is the option? What options are you using? What index are you using? What are the other pieces and parts of this structured product that you might be making for us? And the fact is, we don't know, and in some cases, it's even proprietary. And so
Right.
It's really probably best explained that way, and then let them go straight to Ben and ask for more information if he wants to give that up. But I just thought it was fascinating that here we are. There's a structured product. I'm reading along and I'm sitting here going, wow, a fixed income statement created by layering options over an index. And so I don't know if you
What he
guys
said,
go ahead.
I thought what he said just above that, Mark, was even more kind of poignant.
Yes.
Because he's talking about he's engineered a strategy
Yes.
to hedge the risk. And he said that we proactively engineer the structure of our financial products to optimize risk-adjusted performance.
Yeah.
This is one of the reasons why we categorize the funds as structured products.
Mm-hmm. Yes, and I think that's perfect. Thank you for pointing that out. The other thought that I would mention takes me back to a meeting that I had with Ben many months ago, where he confirmed to me that notwithstanding the status of the structured products that we have available to us right now, he can customize this where depending on the objectives of the fund, we can have this structured for us and customized for us specifically for our target clients or specific target objectives that we want to obtain for our clients. And so again, as you're setting up your funds, as you're looking to create these risk minimization strategies, and you're talking about asset allocation, once you've put, say, the Adagio products into your fund, and you want something else to accomplish something yet different, you go to Ben and you say, hey, I need something else, and I need it to do this, this, and this. Can you help me? And he'll say, yeah, let's sit down and figure out what we can. And in that instance, he may make it exclusively for you, or he may say, hey, let's make this available to everybody. That's a great idea. So just note that it doesn't stop with the products that he's engineered so far. But I just thought it was very exciting to have him disclose to us, at least conceptually, what a structured product has in it. And Jody's point is actually more important than my point, which is this is how we take this to our target clients and help them see that this structured product is actually a thing, and go from there. In fact, no, I'm not going to go there yet. I'm going to wait, but I need to get moving.
Options over index, man. That's amazing. Okay.
Isn't that cool?
Mm-hmm.
Yeah, I hadn't thought of that.
I'm going to pull up something else here. Okay, there's Ben. Okay, so this little diagram you see here down below is the fund of funds. And again, I just want to show this to you because so many of us are still trying to figure out what we want to do and how we want to do it. The fund of funds is basically, and I want to just kind of mention this. This is primarily for people who have strong, large networks of high net worth individuals or people with resources and things like that, but they're not quite sure what kinds of assets they want to buy into their fund. They don't know what kind of asset manager they want to be. They don't know if they want a hedge fund or a real estate fund or a private equity fund. They're just not sure. And so what they can do is set up a fund that, thank you, essentially allows them to put money into different funds. So you have your investors coming in there at the top, you've got your fund, and you turn around and deploy those monies into other hedge funds or other funds. So you can literally put some money into, first and foremost, a risk management fund, right? Some alternative assets to make sure that you have that protecting you. And then you could put more money into a real estate fund. Maybe Toby's real estate fund. You could put some money into Jody's private equity fund, and something else. And so that's kind of the fund of funds concept. And like I said, it works really well with people who want to get something up and going. They have a network that they want to do, but they don't necessarily have a specialty that they have to specialize in. So they create essentially what amounts to a mutual fund, or in this case, a fund of funds that they can invest in. Something else that I wanted to point out here at this stage was a point that Ben brings up about all kinds of funds, but he brings it up in the context of the fund of funds. And that is the need to do some asset allocation and make sure that a portion of your funds are put into something that acts as an insurance policy. Now, we've been talking about that for a few weeks, where you have some alternative assets available to put it into an insurance policy of sorts. This is where you're buying the structured products that Adagio offers as a way of making sure that your investors still maintain the return that you're hoping to get for them with the the specific products that you're developing, such as your real estate or your private equity or whatever the case may be, hedge fund or whatever the case may be. But he's saying here that the industry standard, I've been looking for this from an asset allocation standpoint for a while, and I found it here on page 118. It says, given the industry heuristic or industry standard dictating only 10 to 15% of a portfolio should be allocated to alternatives, and that quality private funds typically have minimums in excess of $1 million. So what that essentially means is that, let's say we have a fund that features the Adagio product. That's all it just features. It's an insurance fund. Think of it that way. And people are buying into that so that they can insure their risk, I guess is the best way to say it. Well, that fund is going to probably take a minimum of $1 million to invest in that insurance fund. So here's where a fund of funds really comes in handy, because this is where you can, and I talked to Toby and James about this last week, about coming in with a lower amount, but in terms of investors, say 50,000 or 100,000, because that's just your niche, that's your avatar. Well, what you can do is, of course, now tell them that you're going to get insurance for this fund by virtue of taking $1 million worth of the total money in your fund and putting it into this alternative asset, which is something they cannot individually do if it's $1 million to play. But as a group, you now can do that. And it doesn't matter whether you've got an investment club or something else, but it allows them to take advantage of that kind of insurance that they would otherwise have to have at least $10 million laying around to invest in order to get that insurance. That's just at 10%. Jody and I have been doing some research where we're hearing that they may need as much as 40%, maybe 50%, just to make sure that the fund is safe. And so that makes it even harder to get it if you're investing only $100 or $200 or $300,000. So again, this fund of funds concept is a good way to, again, democratize this for other people. Any thoughts or questions or comments at this point?
Do you think
I don't
that
think so.
Ben would actually be open to talking to some insurance companies as well? The reason why I asked that is because I know that the IUL, which is an insurance product, it's an index universal life, kind of like it's a permanent life insurance. And you know how the cash value and everything works within there. So there is a 0% floor for people. So they'll never lose money. It'll only go up. And if it does go below, then they'll just flatten out instead of dip. Right. Whereas the stock market dips, they'll flatten out. And I was looking at it, and I was like, man, but the grade of the investments that Ben does and Adagio does are like way better than the S&P 500, right? And the other ones that this insurance. So I was wondering, man, what if we added in these alternative investments with Adagio with this IUL? I mean, it would be safer for the insurance company and better for the insurance clients.
CJ, I think
So
that's
I
an
think
awesome idea. Go
He's
ahead,
looking at that. Yeah,
Oh, is
he's
he?
been looking at that.
Yeah, he's
Okay.
looking at some
Okay.
things in premium financing, and I don't know how that would affect what CJ's talking about. I think CJ's is more fundamental and basic, if I understood you correctly, CJ, is basically how do we ensure that even somebody with just a plain old whole life policy get a better return?
Yeah, exactly.
Well, that would be creating that product and then the distribution for that product. That's the other thing.
So yeah,
That's what Ben and I have talked about, the distribution for for all of this kind of stuff, CJ. And if you'll look at, I think it's called Woodbridge. It's in the book somewhere, I think.
Oh, okay.
And they use their entire, they got their entire investment base. I mean, they ended up in jail because they didn't do it right. And Ben actually talked with them and said, "Hey, I can help you." And they were arrogant and said they had it and are now in jail
Right. Yep.
because it was a big Ponzi scheme, basically. But they got their entire investor group through distributing it through life insurance agents.
Hmm.
Ah, interesting.
But now, what were they
Yeah.
actually selling, an investment, or were they selling
Yeah.
insurance?
They were selling an investment.
Okay. Okay. What I'm hearing CJ talk about, though, is slightly different, where, you know, you've got
Would it
these-
actually be a product?
yeah, you've got these whole life or universal life policies, and they're linked to different market indices. You know, they're basically, if you broke out a whole life or universal life product, and CJ, if you know this, and correct me on this, please do. But basically, a whole life policy or a universal life policy is a pure insurance policy, like a term policy, and then they add this investment component into it. And of course, they link it to the markets and that kind of thing, and they show them how they're getting as good a return on their whole life policy as you get in a good standard mutual fund and that kind of thing. And that's what you're getting. And of course, the idea is there that when the markets are going up, your whole life universal life policies are going up too. But when they're going down, there's a floor, and they won't ding your whole life or universal life policy like you would a mutual fund. Am I characterizing that so far?
Yeah, that's
I think
exactly what
so,
happens.
Mark.
Yeah.
The
So,
problem, though, because I have a ton of clients that have these whole life,
mhm,
universal life policies.
mhm,
And if you do not overfund your policy,
mhm.
it will become useless to you later on.
Sure.
I have
understand.
so many, because a lot of people, they don't realize that the minimum premium, you should be paying in way more than that. But most people will just pay in the minimum.
Right. I think
And
what
so they
CJ
end up
oh, go ahead.
at the end of it with a worthless policy, because now the cost of insurance has outweighed any sort of investment gains that they would
Mhm.
have.
Yeah.
And CJ saying create a life insurance product that's based on the investment going into a fund that Ben has
Yeah.
engineered.
Yeah, with the idea that essentially that there will be more there than would otherwise be there with the market-driven side product, as it were. You know, one of the things you're pointing out, Jody, which is absolutely correct, which is you're talking about one of the structural flaws of whole life and universal life in and of itself. Agreed and understood. I'm just thinking in terms of how do we get higher returns? And so what I was about to say, and again, CJ, you're right, and Jody's right. You want to reform the whole product. You might want to look at
Right.
a combination of premium financing with just a completely reformed life insurance product. But it centers around something that can get a higher return. And so,
Well,
CJ, if you know a life insurance company, if you know somebody there, and say, hey, I think I can get you guys a better return than what you're getting for your whole life and universal life clients. And then let me introduce you to the Adagio alternative structured products. Who knows?
Yeah,
Well,
I
I think
actually got so excited. I did talk to my manager about it, Eric. So he's gonna be looking into that because I did a little video and everything, and I didn't have time to get him on the phone yet. But I just went like it just came into my mind, like, you know, Adagio plus IUL, right? Because what
But
these people are doing is they're getting like, what is it? 2%, 3%, even 9%. I mean, that's not going to keep up with inflation, you know? So
they
like I'm
suck.
seeing 20 or 28% versus the 28 to 28% with Adagio and maybe even more. It's just like, hey, you know, let's give these people a little more than what they're getting, you know.
I think CJ Ben has talked with life insurance, because when you give your money to the life insurance company, they're responsible for like investing it. So I know he's had conversations on the back end, because they have to put that money somewhere. So it's more like aggregating the whole company's investment philosophy on the back end, if that makes sense.
Oh yeah, that makes perfect sense. Yeah.
So let me insert.
The problem in that though would be that the life insurance company would make the return and they would give the
Oh,
itty
yeah.
bitty back. I think you'd have to structure a whole different product, because I'm sure they're, you know, when they sell those life insurance policies, they're tied to an index, and an alternative index is I've never seen that offered to anyone, but
Yeah,
it's
that's actually a
something
good
that we
point.
should definitely, Mark, especially you and I, since we're going to be working with, you know, Thrivent and CFA potentially, that would be a great product for Ben to engineer.
Yeah, absolutely. In fact, that's what I wanted to kind of touch on for the rest of the time that we have. I've kind of used up all of our time, but I wanted to bring something to everyone's mind that Jody and I have worked on this last couple of weeks. And I think it would be awesome to share it with you guys from the standpoint of, you may have the ability to do this as well. And it may be an opportunity for us to do some things, you know, expand the team and do some other things within the context of Adagio. But that is that, you know, as we have been looking for groups, you know, RIA groups or different groups, you know, our approach has been, hey, come take a look at our fund and, you know, look at the alternatives that we have in our fund. And it's really safe because we have alternatives and we're really doing some cool things in our fund, and come look at our fund and consider, you know, putting some of your money in our fund. And as we've been talking about that and we've approached some rather large groups, some of which pay billions in commissions. I mean, this could launch our funds to the stratosphere literally overnight if somebody wanted to do this. But we got to thinking, and we were talking to Ben, and we go, wait a minute, there's even a better approach. So guys, everybody listen up, because this is the holy grail. If you're asking somebody to invest in your fund, they're doing due diligence on you. But if you're offering to help them set up a fund for themselves, who are they doing due diligence on?
Adagio.
Yeah, and who else? Themselves. And so the idea is, wait a minute, let's step left of this for just a second. If we happen to know of some large groups like this insurance company or some other groups that Jody and I are talking to, and there's a bunch of them out there, some RAI group or a big cluster of family offices or who knows what, right? And instead of saying, come invest money in my fund, instead teach them about the concept of risk management. Help them understand that they do not have the benefits of risk management through the funds that they're currently using. And wouldn't it be great if they could set up a fund that met their risk management concerns? Okay. And so what you do is you offer to go in and set up a fund for them. Okay. Now, here's a couple of criteria that you want to keep in mind. Number one, if you're setting up a fund for them, you're going in as a co-GP, right? Because that's how you're making your money. That's how you're making your big money. What we're basically saying is it's better to own half of a really big fund than own nothing of a very small fund. Or I should say own 100% of a very small fund, right? Half of a big fund versus all of a nothing fund, okay? Your fund will come along once you've got a track record and once you've got some success behind you. But what better way to create that success than doing it while building somebody else's fund for them as a co-GP? Okay. Because you've all seen the limited partner structure. You got a general partner and then you got the limited partners. Well, that general partner can be made up of multiple general partners. They call them co-GPs. Okay. By the way, that's one of Adagio's strategies, GP stakes, or taking a co-GP position in other funds. Okay. So CJ, if you're thinking about this insurance company, when you go to them, don't say, hey, I'm going to set up a fund that you guys could put your money in this fund, right? And I'll get your insured a better return. You say, no, let me show you how to set up a fund that will get this return, i.e. using Adagio products. I'll be a co-GP with you guys and we'll share in the profits. And then they're setting up the fund. You're coaching them on it, and all you're doing is coaching them on what Ben tells you to do, right? You and Ben are coaching them on it, but you're going to be a co-GP.
Look at that.
How about that? I knew you'd like that.
The other
That sounds
kicker with
good.
that is it has to be a minimum of $50 million.
Okay, that's correct. I was gonna get to that point. Thank you, Jody, for reminding me. Ben, who you know charges some pretty hefty fees to help set up funds, says that he won't charge a fee if they can commit to a $50 million fund. So in other words, as they're setting it up, if they believe, say, take this insurance company, for example, you know, if they've got a couple of $1 billion worth of insureds, and so you know they've got investment money in the hundreds of millions or billions of dollars, okay? How hard would it be to throw 50 million, which might represent less than 10% into a risk asset allocation? Wouldn't be that hard at all. And so they
Now
can say,
that's not going to help the current policyholders get any bit better of a return, but
no, you'd have to restructure the products. I'm not going
Right.
into that level of detail. I'm just talking conceptually. If you could have them move $50 million into a fund, you know, and I'm talking about whether it's insured, whether it's RAAs, whether it's, you know, any group, any concept. If they're willing to move 50 million into that fund, Ben will do it without charging a fee.
Nice, because the product is just straight up better, right?
Yeah.
Not only is it better returns, but it's also safer. So I
Mhm.
don't see how, if we presented it correctly, they would say no to that, because they're all about safety. Banks are all about safety. You know, insurance is all about safety.
So yeah, Jody brings up a really good point. I don't know how all that works. I'm not that technical on that side, but the point is that if you find a group, whether it's RIA, whether it's insurance, whatever, and instead of approaching them with put your money in my fund, it's let me help you build your fund. I know what I'm doing, and I'm connected to Adagio, who's backed by Morgan Stanley. And so they don't then do due diligence on you. They'll look at the Adagio products. Their due diligence officer has to do that. But we've got all the due diligence done on that. So that's the easy part. The point is you're taking yourself out of the equation by reinserting yourself into the equation at a different place called a co-GP. And then they're not looking at you. They're looking at the fund they're building and that you're helping them build. Does that make sense? Toby, James, that was what I was gonna share with you on Thursday, by the way.
Yeah, that's awesome.
more.
What's that?
This is
That's
outside
awesome.
of this group, but maybe that's how we need to approach Michael Strong.
Yeah, maybe that's what we do, is we approach it that way, and then essentially you don't have to pay him what we were gonna pay him. Essentially say, Michael, it's your fund. You pay yourself however you wanna pay yourself. And go in as a co-GP. If he really has the people,
Right.
you know, if he really has that kind of network, then absolutely, why not? then he's not doing due diligence on us. He's just simply doing due
Right.
diligence. He's just setting up his fund and we're just helping him do it.
Yep. I think that might be a better approach.
Yeah.
So wouldn't Adagio actually be setting it up?
Well, you would actually probably help them go through a lot of the basics. In fact, that's where we were kind of going to go next in the conversation.
Okay.
How to set up a fund. Okay. First of all, there's some marketing documents and some legal documents and some legal compliance considerations, right? What I would do is the value that I think you want to bring to the table goes back to our buddy Bridger, if you think of him, okay? In other words, you're going to come up with the deal structure. You're gonna propose that to your new client, okay? You're going to talk about the waterfall with the client. You're going to help set that up. You don't need Adagio's help with that. If you understand the material in the master class, like Ben wants us to do, he wants us to master this, like, you know, learn it like the back of our hand, then you should be able to go in and talk about the structure, the waterfall. You can come up with the pitch deck, okay? Help them with the pitch deck. You know, you're not doing this by yourself, but you're basically leading that effort. You don't need Ben to do this.
Right.
Okay? So you're coming up with the pitch deck. You're coming up with the 2-page summary. That's a marketing document. You're coming up with probably at least a draft of the LPA and the PPM as far as the rules that you want to have in that fund. Okay, you're going to be reviewing the rules with your client. Now they're your client. And so you're coming up with those rules and making sure that those are in there. Now, at that point, Ben and Adagio are going to want to take a hard look at what you've set up. Okay, at that point. They may have some coaching for you. They may have some suggested tweaks. They may have some things that in sitting down with you and the person for whom you're building the fund want to meet with Ben and Carl, and they review that and say, okay, you're going to want to think about this, think about that, consider this, consider that. And you go back with your client and you're going to tweak your pitch deck, you're going to tweak your waterfall, you're going to tweak everything about it, you're going to tweak your rules, your Bible, you know, you're going to change everything to meet those, you know, suggestions, right? By the time you're finished with that, you may end up using either Adagio's attorney, legal advisor, or you might have your own, but they'll be drafting any official legal documents that that need to be drafted, just to make sure that they pass the legal laugh test, right? And that there's some fee, and there's going to be some fees for this all along the way, which, by the way, CJ or Anthony, these fees are going to be incurred by your client, right? They're going to be fronting those. You don't have to at that point, right? They'll front those fees. And then at that point, you're pretty much ready to go. You're ready to green light and pull the trigger on that thing. As you then pull the trigger and you're now putting structured products into your client's fund, and you're you know, getting Adagio's products put in there, and you're helping them with any other due diligence they want to do with respect to Adagio, or, you know, looking at the back testing, you know, looking at the risk, creating asset allocations and all that kind of stuff. That's something now that you can sit down in tandem with Adagio and work those details out, right? But the first phase there of the things that I've talked about are right there on pages 121 and 122 in the book. So it's right around 2 hours and 5 minutes in the master class. And so if you do the things in the book first, and then of course there's a section there where he talks about raising money in the tale of 2 client profiles. So on page 126, he talks about how a more sophisticated client raises money than, say, a newbie. And so if you go into this obviously going in the first time you're a newbie, second time you do this, you're a sophisticated client, right? Because you've learned it all. But anyway, the steps are there, and the delineation between what Adagio will do for you and what you need to do for yourself to prepare for Adagio is fairly well delineated. And those are some questions that you can come back with in our Tuesday night labs. Say, for example, you're not sure, gee, do I launch into this draft of an LPA just so that I can get my head clear about what it is and what it does? Sure, why not? I did. And I'm doing the same thing for a PPM. Does it mean that I won't need an attorney? Of course we will. We'll still have an attorney review it and look it over and make sure that it's correct and rewrite it as they all want to do. But it'll be a lot cheaper, you know, if we've got it all hammered out. And so, Toby, did that answer your question?
I don't have a question.
Oh, I thought you had a question about what we ought to be doing. Or you made a statement and I took it into that section, but anyway. That's pretty much what we're doing. Stop sharing. Any other thoughts or comments? We're kind of wrapping it up here. Anybody glean anything out of all that today?
Definitely.
Yeah, it was a lot of good information for me for what I heard today. But I think I'm gonna have to watch the replay because I was busy handling work, you know.
That's good. I hope I can get this one up. I recorded it on my laptop rather than on the cloud. And so hopefully I will have a link or something that I can put up and get it up there. Otherwise, I've just got to get this thing on YouTube. I got to get them all up on YouTube. So
I do have a question. So I've been working with Jeffrey. I think Jeff, is that how you say his name?
Jeffrey Wilson. Jeffrey Williams.
So we've been trying to craft a letter to introduce the fund to my clients.
Okay.
So I didn't know if anybody had a template for that they use currently or what, because it just, you know, a simple introduction for them to have a phone conversation with me. And then if we need to move forward for a phone call with him, we would have one with him. Otherwise, we would just do the subscription paperwork and, you know, get the check. That's pretty much how we're looking at it.
I don't know. Any of you marketers there have a templated letter you use to send an email out to somebody or a letter out to somebody?
I don't yet, Mark. It's something I'm working on.
Well, I was about to say, Jody had a great PowerPoint presentation that you could probably, you know, I know it's probably not going to be like 30, 40 pages that they're going to want to read, but if they were to, if that PowerPoint were to be transmuted into a letter, that would probably be something to look into.
That's a good idea.
What I've been working on is there's a really great way to do email when you're reaching out to investors, and I'm going through the Oren Klaff class to kind of hone in on that, because the way he structures emails, he gets 7 to 8 out of 10 meetings.
Whoa.
Wow.
Yeah, like it's
Wow.
but they've sent
That's
out
high.
millions of email.
Hmm.
So I'm going through that class, and he is adamant that less is more. You want to get them on the phone. You don't want them, you want to be able to get them on the phone and explain things to them or set up a face-to-face meeting, because you're not going to just do it via email.
Not gonna sell over email.
You may, but I mean, like for us, I mean, like with Jeff's fund's a little bit different. I think he has like a $50,000 minimum. But and that's still a lot of money to someone to just, and you're not going to explain it, I think,
Well-
in an email.
Right. Well, my letter will be kind of going out to and tailored to my current clients that I've already done business with, because we
Right, so
decided
you
that,
already,
yeah, we
you already
decided
have
that
a
it
warm.
wouldn't, yeah, it wouldn't be me marketing his fund. It would just be me referring clients that I already have and keep my marketing that I have in place right now that already attracts investors that are looking for better returns. And
I
he just said,
wonder-
you know,
Anthony, if you went out there, just Googled super affiliate emails,
okay,
and focus on the word super affiliate, you're going to see super affiliate templated emails for everything from dietary supplements to potato launchers. But if you read through a few of those, you'll notice that super affiliates that already have a warm market, already have a connection, and they're just simply trying to refer their client over to someone else who is a stranger. You'll kind of gauge how they reach out to their clients, reach out to their customers and say, hey, I've got somebody here that I really believe in, and I think you will too. Give them a call or click here, or take them someplace where Jeff wants them to go. And you might find that they are written in a way to essentially, if you just kind of take out the potato launcher information and put more of a something that might hit the pain points, I guess, of their current investment situation, then refers them over to Del Talk. That's a way to do it. I don't know if that made sense, but if you Google super affiliate email letters or something like that, you'll see a whole slew of them out there online that you can then kind of grab a couple of them and just redesign them to
Anthony,
your liking.
Are you sending them to like a landing page to schedule an appointment, or you just
no, because my clients have my personal cell phone number. So I just figure I would just send them a letter kind of introducing this new thing, new opportunity that's available to them outside the norm of what I typically have. And then they need to call me. And then from there, I would kind of close the deal. But if I needed help, then I would call Jeff to
Gotcha.
kind of help go in with that. But he does have a presentation, and he sent me, his presentation. Then he also has a snippet of Ben's presentation as well.
I think they get too technical on that.
Yeah, but it's only 30 minutes. So I
Yeah.
probably wouldn't show that unless a
Right.
client was just like, let me get more information. If I really want to know how the nuts and bolts and how everything works, then I think I would show that to them.
Right.
If you want to triple your response, instead of having them reach out and call you, have them just simply reply interested, and then you reach out to them.
Got
That's
It's
true.
a lot easier to hit reply, type one word. You'll get way higher response rate. from
Yeah,
that.
in the moment, people will write, yeah, I'm interested. And yet if you have them take a bigger action than that, you might not get as much of a return, a satisfactory
Response.
response. Yeah, that's what I'm trying to say.
Right.
And so, yeah.
That's a good point, Toby.
And then,
What do they
and
call
then
those?
they're interested, so you're going to call them and it's a warm call at that point.
Cool.
Thank you. Is there a term for that, like micro agreements or something like that?
Micro agreements?
Yeah.
Is that what they're calling it? Is
I
that what
don't know.
the attraction
That-
marketing guys are calling it? Micro
That's what,
agreements?
maybe, I don't know. That's what I have in my head, like small agreements kind of lead
It's a
them down the
micro
path.
action,
Or
Micro
micro
action,
action.
yeah.
Right.
less resistance, because there's a lot of resistance in picking up the phone and making a phone call
Mhm.
and thinking, well, how long am I going to be on the phone? Is he going to try to sell me on something? I'll do it later. And then that never happens, right? But if you're right there on the email, hey, if you're at all interested, just hit reply and say interested, and I'll reach out to you or we'll schedule a time. Way less resistance.
Well, there's some ideas there, Anthony.
Then you're also not sued for a do not call violation.
Well, most of them, I'm gonna send a letter out, just because I don't have their emails, and all of my clients are typically over the age of 75, so they're not all computer savvy, you know what I mean?
Yeah.
Well, you could do something similar if you send a letter and send a self-addressed stamped envelope
Okay,
Or a card.
true.
that they can just send back to you.
Postage paid
Yeah.
or something like that.
Postage.
If you
paid
want to use
card
the
on
same
there.
concept, but yeah, or you could just ask for a phone call or.
Yeah, I'll probably just have them call me on my personal cell, because all my clients have my personal cell phone number, so
Okay.
I think that'll be.
Well, you know
easiest.
your clients, if your clients are prone to call you because you've given them your personal cell, then go for it. That probably
Yeah.
be just fine.
Yeah. Well, I'm gonna get out of here, guys. I'll watch the
Okay.
recording. Hope you have a great evening, y'all.
All righty.
Thank you. You
Have a
too.
good evening, everybody. Bye.
Thanks,
All
Mark.
right, have a good one.
Yeah.
Thank you, Mark.
Bye.
Take care, y'all.